Hey guys, last week I put out a video going over the breakdown of what in my opinion is the best guess of when the next recession may be. In the times of economic downturns, certain real estate investing strategies work better than others, and as a real estate investor, we are always following the market to see what the market is doing and adjusting to it accordingly. That is the game. So in this video, I want to give you the one real estate investing strategy that has proven to be the most resistant to recessions and inflation. I will tell you what that strategy is and also why it works. So to start out, if you are a wholesaler, it really does not matter what the market is doing because you are not going to be holding on to that property for very long. So each time you can adjust to the market accordingly. But when it comes to every other real estate investing strategy, the state of the market makes a big difference because you are in it for a longer term. So if you had some houses that had been rentals for the last 10 years that are now at the rehab point, I would not be rehabbing those houses and I would not be putting more tenants in them. Because if the economy tanks and 50% of those houses go vacant, there is no covering cost. You would have to pay for each one of those houses all the time. So if you picked up those houses in 2010, they appreciate 5 and 6 times their value. So I may be considering selling them and creating a cash position to do something else. Basically, I would take my profits and run. I would not be going to land. Commercial real estate, I could get into that, but this next strategy is cheaper to get into. It is a 12-unit or more apartment building. So I may be considering taking that cash and putting it into multifamily. So I know it is great if you have the reserves or if you have the knowledge of how to fund the acquisition of such a building. But if you're just starting out, then don't worry, I got you too, because the next video that I'm planning to put out is on a real estate investing strategy that I believe is one of the easiest ways to get into real estate and just start to cash flow quickly so that you do have enough funds for a down payment on one of these buildings or whatever piece of real estate that you want. So look out for that video. But going back to multifamily, let's answer the main question. Why is it the most resistant to inflation and recessions? And that is if the economy tanks and 50% of your building goes vacant, you will still be covering your costs. So it is simple math. And to see that, we have to figure out the NOI, which stands for net operating income. It is going to tell us how much we can make off this building. So to figure that out, you have to take the gross income, which is the sum of all the rents added together and multiplied by 12 months to get the yearly gross income. From that, we have to subtract the vacancy rate. This is the number of units that are empty, that are not rented out. In today's market, the vacancy rate is 0. Most of the time, for most apartment buildings, it is somewhere around 10%. In a bad market, it will be as high as 50%. The other component of the vacancy rate is the cost of vacancy. It is bad debt. Basically, you have a unit that is rented out, but the tenant is not paying rent, and the landlord hasn't been able to get rid of that tenant yet. So that unit is not producing income, but the landlord is not able to put a new tenant in there yet. So a percentage of that you can always calculate. So once we subtract the vacancy rate from the gross income, we get the adjusted gross income. But we still have operating expenses. Things break down, there's repairs that need to be made. The landlord may not be the one operating and managing the building, so he or she may have hired a property manager. So all the costs and all the expenses associated with having that building, maintaining it, and running it are part of the operating expenses, and we have to subtract that. Once we do that, we finally get the net operating income. So let's say that each one of these units rents for $500 per month per unit. So we would have to multiply that by 12 units, and we multiply that by 12 months. That would give us the gross income for the year of $72,000. Let's say that the vacancy rate now is 5%, so that we can include that in there to do an example. Let's say that bad debt is 2%, so that's 7%. So let's figure out what that would be. So we would subtract $5,040 to give us the adjusted gross income of $66,960. Let's say that the yearly operating expenses come out to $8,500, which would give us the net operating income $58,460. So basically, you can use this equation to figure out your net operating income. But the key to making sure that this investment is even worth your time to begin with is to buy it at the right price. To help you figure out the right purchase price, you want to use the cap rate, which simply equals risk, which equals the price tag of the building. Simply put, cap rate has everything to do with the stability of the income. So the lower the cap rate, the more stable the income, the less risk you are taking, but the higher the price tag. The higher the cap rate, the less stability of the income, the more risk that you are taking, but the lower the price tag of the building. So if I'm looking and considering at purchasing this building, but I'm looking for a minimum of 8% cap rate. So what should my purchase price be to get 8%? Here's a little trick that I learned that I use to help me with the math. So from here, we just plug the numbers in that we know to figure out the number that we're missing, which is, in this case, the purchase price. So when we do the math, these rents and all of these costs are telling us that this building is worth $730,750. So we would have to buy this building for this much to get a cap rate of 8%. So in a recession, as vacancies increase, that drives the little number down, which means that the value of this building decreases. So as a result, this big number comes down, which means the purchase price drops. As an investor, it is a great time to buy a building like that. So when you do buy a building like that, you just have to improve the vacancy rate to improve the value of the building. So how do you do that? Well, you can do what every other landlord does by dropping the rent. But you would only be dropping the rent on the units that are not rented. So you're still making money because you're not dropping the rents on the units that are. If you are in a house and you drop the rents, there's no other units rented because it is just one house. I'm not saying that houses are a bad investment. They make a lot of money. But when you're trying to recession-proof your real estate investing business, multi-unit buildings are just a lot more easier. So that is the reason that multifamily buildings are the most recession and inflation proof, more so than any other investment. So this whole time we have been focusing on a very traditional long-term rental type of model, which is fine. But another reason why you may want to look forward to my upcoming video is that the same strategy that I'm going to be talking about, which as I mentioned, is in my opinion the easiest way to get into real estate and the easiest way to start to cash flow quickly, is also the same strategy that is going to help you decrease the vacancy rate and help you have more of the units rented and increase your income. So be sure that you are subscribed to my channel so you are notified when that video comes out. If you found this video helpful, please leave my video a thumbs up. If you have any questions, or if you want to leave your thoughts, or if you have any suggestions for topics that you want me to talk about in any of my future videos, leave all of that in the comment section right below this video. Thank you so much for watching.